Good evening, Ken at Tortoise Capital with a review of the daily trading report for August 14th, 2019. Market in this bullish, volatile, but very choppy. Once again, big signal day, mostly directional, mostly signal. This time it gapped down and then collapsed in the market. So now it's in the bottom of the 10-day and 30-day trading range. MACD is still firmly in the winter. The risk Z is also in the winter, so this is not a time to be swing trading. I like the opportunity shaping up for a test of this triple support level here, around 284, let's call it. Last time here it made a nice run in this little move with 2 days of follow through in a row. But still, you're noticing the big range days and no follow through day to day, these last 5. So getting close to the sideways market in here. So this is a market to shorten up your time horizon. Don't be in a hurry. Don't chase. Bird in the hand is worth 2 in the bush. In fact, we just tripped just in over the edge into sideways volatile. That is not a time to be swing trading at all. You can see the oversold conditions on multiple look-back periods. No channelings and overreactions yet. The max pains are the ones that have fallen the most from the 10-day. Min pains the ones that have fallen the least from their 10-day high. And again, you notice risk Z at an extreme reading and still deep in the winter. Almost 2.5 Z-scores. Excuse me, below the long-term average. Lots of auto framers to choose from. Only a couple dojis in the Dow. Disney was a channeling and overreaction. Home Depot. Notice the large number of NDX breakdowns in the different time frames. Pfizer with an RSI2 value of 1 is worth framing. See the big percent losers today in red. The percent winners today in green, but notice they all lost money, but just some didn't lose as much. But today was just a miserable day. There were a lot of hopes dashed with today's price action. A lot of people got trapped in that little bounce from Tuesday. ETF 30, lots of auto framers to choose from, a couple channeling and overreactions in materials. Notice the defensive plays. Treasuries made a big bounce, big breakouts in every time frame. That is a strong vote for defense. Gold and silver were huge again today. And then the large number of breakdowns across the board, Mexico especially suffering. And look how bad that is. And oil exploration continuing to get murdered. Positive Z stretches, the defensive plays. Negative Z stretches, these are the inverse relative strength, the relative weakness, I guess we should call that, the RWI. The most expanded pinch boxes come from consistent directional moves. That's why the river is so wide, and this is the Z-score of how wide that is. Just notice the magnitude of the directional move, like in Pfizer, for example. Amazing. 18% below its Bollinger Band river. Definitely worth looking to buy at quality on sale. And then some potential pinch boxes shaping up. McDonald's, Microsoft, as well as utilities. Lots in the auto framer to choose from with mechanical trade frames. These regression line fractal frameworks, this is the number in the top shelf of how many ATR below its fair value it is. So that's the distance between the RL10 and the RL270 in ATR chunks. And then in red are the ones that are overheated. That's how far above their fair value they are. So like Apple is almost 3 ATRs above its fair value, and so forth. Daily squeezes, these had relatively narrow ranges compared to their range stat, which is the maximum reasonable intraday move. When you compare the range stat to today's range, and that ratio now gives you this magnitude of a breakout that's possible if you just use the range risk as the risk. Four Seasons of MACD. Notice the vast majority of things in the winter and suffering only a couple of the defensive plays in the summer. And the elements in the spring are ones that are starting to roll up, although they are still below the zero line. But you can see just how far below their Red River they are in terms of z-scores. You can actually look at this as a proxy for market condition by looking at the number of those symbols that are in winter. That ought to tell you how broad-based this weakness in the indexes are. The multi-time frame NDX summary based on the days of look back, and everything in deep red are ones that are below the previous look back period's low. So that means big breakdowns in both ETFs and the Dow. This is sorted by the 10-day look-back period, which is my default swing. This is kind of a down and dirty sorting mechanism for swing trades when I use the 10 as an example. You could think about the 270 NDX as something like a long-term buy and hold relative strength. So these are the real relative strength leaders, the ones out here in the green. So you can just see how murdered Pfizer has gotten. It was a breakdown in every time dimension. Cisco and Cat not far behind. Or ExxonMobil and Boeing for that matter. And then XOP oil just got slaughtered. Strength in treasuries. Gold, silver. ADX strength of trend. The usual. So just as a way to read that, today's ADX in EPP is 34.6, which is a 2.2 z-score strength of trendiness. That's how you read that. Its normal range would be between 26 and, say, 12. So if you look at this from just a market perspective, you see the normal range in SPY would be from essentially 33 to 15. And then breakouts above that are extremely trending in one direction. And so you can see the reading in S&P at 31 is getting close to that upper limit of normal directional trends. So it's this kind of bearish move lately is just starting to get vicious. It hasn't even attacked yet. That's how much more room to the downside there could be. Market rejected that bounce. Regression line is down. The polynomial is down. We are more than one SD below the long-term average in terms of downward slope. We're testing some percent stretches here in the S&P. And that slope is really at a place where it found support last time for this run-up. And that so there is some hope that if this 285-ish area holds, or north of 284, I should say, then a return to goodness is possible. But that's not where the indicators are pointing. The easier path is downward right now. ATR volatility spike. Even the 30-day price SD is starting to spike. Rejection of the southern skin of the river. Now notice the river itself is rolling over. Next stop is down here at 275, the last support level. And then just some quick references. So lots to choose from, but I think you got to get the market right. And this is a time when you want to shorten up your time frame and really be sure that you lock it in when you can. Don't get frustrated. Don't have a directional bias, or the intraday moves are going to find their own level, and there's not a swing pattern in here that's really pointing one way or the other. So this is a critical state, emphasizing the short term. Keep your risks measured and your powder dry. Hang in there.